Good afternoon. This is Tim Fry, a McGuireWoods healthcare attorney, and throughout today's webinar, please take advantage of the Q&A box on the application so that we can try to get to your questions either during the webinar or thereafter. It is an honor to join you today with my colleagues. We are appreciative of the trust you've placed on us during these difficult times and truly hope that you're staying safe with your families. My colleagues who will be speaking today in order of the agenda topics are as follows. Amber Walsh, Chair of our Healthcare Department, who will be discussing PPP issues. Holly Buckley, Chair of our Life Sciences and Healthcare Industry Team, who will be discussing the Provider Relief Fund. Kayla Marty, a colleague of mine in the Healthcare Department, an absolute superstar who we trust deeply and will be speaking on the Main Street Lending Program. I'll spend a few minutes on a new an HHS Uninsured Reimbursement Program, and then Gerald Thomas, the chair of our firm's tax department, will round it out with some updates on the PPP program and its interrelationship with IRS guidance. Please feel free to reach out to all of us after this call, including through email or LinkedIn if we can be helpful. On this today, we are speaking as an update from our April 21st webinar. That webinar gave a lot of the basics and introductions to the programs that we will be speaking on today. Just briefly before we do that and get to the meat of this presentation, wanted to pass along a couple key federal changes that had occurred that are displayed on this slide. Congress passed an additional $75 billion for the Provider Relief Fund that Holly will be speaking of. Some of that will include some of the programs she will discuss, as well as additional HHS funding that has occurred since our last call, including $22 billion for hard-hit COVID-19 hospitals and rural providers. In addition to the Provider Relief Fund, since our last call or last webinar, we talked then about the Medicare Advanced and Accelerated Payment Program. CMS has suspended that program for Part B providers. You cannot continue to apply for those funds if you're a Part B provider. Repayment for any advances already made will still be occurring, coming in 121 days after your funds were received. Part A providers can still apply, but they're going to scrutinize your application more and understand if you truly need the funds. And so if you have questions there or had thought about participating, we'd welcome those in the Q&A portion of today's call, but wanted to give that very brief update. With that, I'm going to turn it to Amber Walsh to discuss some of the major changes and updates to the Paycheck Protection Program, or the PPP program. Amber?
Thank you, Tim. So since our original April 21st webinar, there have been a number of updates, largely in the realm of loan eligibility. There have not been a lot of updates in the past 2 weeks regarding the forgiveness phase of the loan program, but really about the eligibility standards. I really would encourage you to look back if you are still in the early stage of assessing eligibility, or you are going through a reassessment in light of all the current guidance. I would encourage you to go back to the slides for April 21st because we don't repeat those here. Rather, we're talking about updates. So the SBA has issued several interim final rules since then and updated the FAQs. And the FAQs have really provided a great source of information to get SBAs thinking. They are up to 44 as of this morning, but there are a few that are frequently cited and that have gotten a lot of attention in the past couple of weeks. Here are the updates, and I will just remind you that these eligibility updates are largely in addition to the eligibility standards that were already in place. So, for example, affiliation analysis in determining whether or not you are affiliated with another entity such that your employees or revenue needed to be counted with that entity. Those rules that already existed have largely remained unchanged. These are really additional standards for eligibility. So first, there is an aggregate limit stated. What that means is that businesses that are majority owned directly or indirectly by a common parent are not eligible for more than $20 million of loans in the aggregate. That's amongst all entities related in that fashion. Second, and this is the really big one, this comes out of interim final rule and then FAQ 31. For those of you who are closely tracking the FAQs. This is the necessity standard. And what this says is that all borrowers must assess their economic need under the standard established by the CARES Act and the regulations at the time of the loan application and certify in good faith that their loan request was necessary. So just to elaborate on that a little bit. The standard established by the CARES Act, while it certainly eliminated the normal requirement for small business loans that the borrower be unable to obtain credit elsewhere, it does include this statement, this certification that you see there in bullet 3, that the current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. The necessity component is really key. Borrowers must make this assessment, and lenders are permitted to rely on the borrower's assessment and the borrower's certification. Borrowers must take into account their current business activity and their ability to access other source of liquidity sufficient to support their ongoing operations in a manner that is not significantly detrimental to the business. That is the standard. So you are not obliged to exhaust numerous potential debt sources, but it is a heightened obligation to consider your liquidity. Borrowers need to document their good faith determination. They should be prepared to demonstrate to the SBA the basis for the certification. And I would really encourage those of you who went through an eligibility analysis early on before the application and documented your determination of eligibility, would encourage you to go through a reassessment under these new additional standards and document that you thought about it as well under the new standards. Just a few things as we flip on to the next slide. A few more clarifications for SBA. One is in that FAQ 31 that I mentioned, which is frequently referred to throughout the FAQs, SBA stated that it is unlikely that a public company with substantial market value and access to capital markets will be able to make the required certification in good faith. They later came back and said that the same thinking could apply to a private company, including a portfolio company of a private equity fund. By no means were they saying all such private companies were ineligible, or frankly, all such public companies. But it is a mindset. They are sharing the mindset of what they believe to be eligible, and they really are kind of heightening the standards to pay attention and make sure that all such company types are really thinking about the necessity standard. That is one of the biggest changes in eligibility that's come out, and it has led to, amongst a few other eligibility clarifications, such as for nonprofit hospitals, for example. There's now a broader pool of nonprofit hospitals that are eligible. But the necessity one was really the big one. So in light of these changes, SBA has announced that for any borrower that applied for a PPP loan prior to April 24th, just applied, and repays the loan in full by now May 14th, they've extended the deadline since the original May 7th, you will be deemed by SBA to have made the required certification in good faith. So we are in a period of time right now that's really critical for those who applied prior to April 24th to really do this assessment and ensure that you remain comfortable with your eligibility. If you do remain comfortable, there's really nothing for you to do other than properly document that and prepare yourself for the forgiveness phase and potentially the audits, et cetera, that may be coming. Whereas those of you who have determined that under the new standards, you're not eligible, you do have until May 14th. They have promised guidance to further elaborate on these standards. All of our thought leadership and certainly your personal relationships at McGuireWoods can be good sources of information for the new things that come out on this particular point prior to May 14th. And then, of course, they'll talk about the methodology, but that'll largely be dealt with your own lenders if you do make that determination to repay the loans. One more quick note on audits. Secretary Mnuchin announced that SBA will audit these loans above $2 million and has warned of criminal liability for improper receipt of the loan. Furthering this, SBA then came back and said it will review all loans in excess of $2 million following the lender's submission of the borrower's loan forgiveness application. So to be clear on this, these standards that we are talking about here are for applying for the loan on the front end. They are not the forgiveness standards. So let's quickly move to then the loan forgiveness standards. So once a borrower who has applied and received the funds, everyone knows that we've got this critical 8-week period post-funding to maintain proper documentation that the PPP funds were used in the right fashion. This slide here is largely duplicative of the April 12th version, or excuse me, April 21st version, because a lot has remained the same, frankly, on forgiveness. We are expecting more guidance on forgiveness. Right now, it appears that SBA and the bar and everyone else involved is largely focused on eligibility. But soon, as the 8 weeks for the early recipients of the funds come up, we will soon be moving into the loan forgiveness. So those of you who are just now getting into that phase and documenting it, this will be a good slide for you. So I'm not going to spend too long. I'm just going to zip through it really quickly. It is important to understand that while not automatic, the loans are 100% forgivable if the recipient documents the use of funds on the eligible expenses that you see listed there during the 8-week period following loan funding. Payroll, mortgage interest, rent, utilities, as further elaborated on the slide. Other limitations on forgiveness, though, of which to be aware, and this is what we expect to have more guidance. And in fact, a few of these, SBA has promised very specific guidance. The number of employees, that is a further potential limitation on your ability to get the full loan amount forgiven. The loan forgiveness will be reduced on a sliding scale if the recipient reduces its full-time employee count. Secondly, a reduction in salary and wages. Forgiveness will also be reduced if the recipient decreases salaries and wages by more than 25% for any employees that made less than $100,000 annualized in 2019. Then there is the rehiring limitation on forgiveness. The recipient has until June 30th to restore full-time employment and salary levels for any changes made between February 15, 2020 and April 26, 2020. There's been a lot of questions about this one in particular because, of course, during that critical period, many borrowers who are well-deserving of PPP loans also had to make very difficult decisions with their employees. So they will be issuing guidance on laid off employees whom the borrower offered to rehire, but for whatever reason, the rehiring didn't occur. So we are expecting that. And then finally, non-payroll costs. As noted above, mortgage interest, rent, and utilities are a component that is forgivable, but not more than 25% of the loan forgiveness amount may be attributed to these non-payroll costs. So I'm going to turn it over to Holly now to talk about our next topic, but encourage you to put any PPP-related questions in the Q&A box, and if we have time at the end, we will certainly try to address them.
Great. Thank you, Amber. I'm going to be providing an update on the so-called Provider Relief Fund, and specifically the portion of it that's referred to as the general distribution, which is the $50 billion that's going out to any provider who billed Medicare in 2019. So as many of you know, between April 7th and 14th, the first $30 billion was distributed, and it was distributed again to any provider who had billed fee-for-service or other Medicare in 2019. A second wave of $20 billion was recently announced to also go out, and we'll talk about that in a minute. In terms of the initial $30 billion, the attestation deadline is coming up, but providers are deemed to have attested within 30 days of receipt if the funds are not returned. There's an attestation portal out there. The link to that is in our initial slide deck, I believe, but we'll certainly make that available to anyone that's looking for it. And if providers determine they need to return the funds, they can either reject the ACH or return a check to United Healthcare. We do expect there to be some significant amount of fraud and abuse auditing with respect to these funds, although with the government having pushed these funds out proactively, especially the initial $30 billion without providers doing anything, we think there'll be some level of deference given for the fact that the government push these funds out in terms of we think the government will likely seek recoupment as an initial remedy if there are concerns with the funds. Moving to the next slide. I'd mentioned that the first round attestation is due this weekend. By our math, we think that'll be May 10th, Sunday, for the people who first received funds on April 11th. April 10th. The first round was distributed proportionate to the provider's share of Medicare fee-for-service reimbursement in 2019. And the criteria for keeping those funds and the terms and conditions include some of the following items. No balance billing of presumptive or actual cases of COVID-19. Now, the initial language on balance billing was a little bit different. And it was less clear, but the government did confirm that the balance billing restriction really is related to solely presumptive or actual cases of COVID-19 treatment and testing. The payments are to be used only for preventing, preparing for, or responding for COVID-19 and healthcare-related expenses and lost revenue attributable to COVID-19. And we'll talk in a minute about the different uses of the funds and ways to think about it. There's a certification that the provider or supplier provides or provided after January 31st, 2020, diagnosis, testing, or care for individuals with potential or actual cases of COVID. And that's been very broadly construed as if you treated a patient after January 31st, 2020, you likely meet the criteria. The provider or supplier must not be terminated from Medicare or excluded from Medicare, Medicaid, or other federal healthcare programs, and not have Medicare billing privileges revoked. You also must certify that you're not using the payment for expenses or losses reimbursed from other sources, and that you meet other criteria. So other funding criteria, which is derived from other kind of grant funding language, which we'll talk about in a second as well. So we've been answering a lot of questions in terms of, well, how do we actually use these funds, or how can we use these funds? And we really view this to be in kind of three core buckets. The first bucket is the kind of it's easy, this is what it was, very plainly intended for. The next bucket is you could potentially use it for this, but with caution. And the third bucket is you certainly can't use it for that because there's very explicit language. So in terms of the first bucket, in terms of what could we use it for, the items that kind of make sense, and we say all of these need to have a reasonable nexus with expenditures or lost revenues related to COVID-19, but things like payroll support, telehealth expansion, staff appreciation, hazard pay, purchasing PPE, additional inventory necessary to support surge capacity, paying rent and utilities to ensure offices remain open, and consulting and other fees needed to support the business in this different context. Those things all make a lot of sense and are really kind of consistent with the language put out by HHS. I'm going to take the third bucket second, which is kind of the you can't use it for these purposes items. And there's a specific list within the terms and conditions that tie out to other rules. And there are things like you can't pay high-income individuals annual salaries in excess of executive level 2, which for 2020 is $197,300. You can't use them to advocate or promote gun control, for lobbying, funds for any abortion. There's a couple of exceptions there. To create a human embryo for research or destroy, discard, or subject a human embryo to risk of injury, promote legalization of controlled substances, and there's other ones that are kind of like that are these, you absolutely can't use the funds for that purpose. And then the second bucket, which is the kind of maybe bucket, is the one that's really the most challenging. And the reason we put these uses in a maybe bucket is because the Provider Relief Fund reporting may well be discoverable through the Freedom of Information Act. And we recommend really considering how the public and media may view certain uses of funds and the level of scrutiny that may well follow the various different buckets of funds to say, how would this look if someone else were to kind of publicize this? And so things that would put in this bucket could be funding for or income support for high-income individuals, or bonuses if lower compensated individuals were furloughed, or owners taking distributions or doing share buybacks, or other things that are just kind of less related to the COVID pandemic that may be subject to scrutiny. Now, there may be reasons to make payments related to these items that make sense and are defensible, but there's just a bucket of items which say just think very carefully about and think how best to kind of frame these items if they are ever reviewed by individuals outside of the organization. The second bucket, or the $20 billion general distribution, is in process currently. For cost reporting providers, HHS funded automatically, meaning they didn't have to take any action. Amounts just showed up in their account based on data the government already had. But other providers, they had to submit through the portal, and it's not too late, we believe, if other providers want to submit and haven't done so yet. But in order to submit for the $20 billion, it's necessary to attest for the $30 billion affirmatively, meaning you can't just be a deemed attestation by taking no action. So once you've attested to the first bucket, or to the first payment received, you can then go ahead and apply to the second billion. Now, there's a formula that HHS has put out. They didn't initially put it out, but they've put it out now, that says that you can basically use to calculate how much of the total $50 billion you may be entitled to. And the formula's on the screen, but it's taking total 2018 revenue, so that's not just Medicare, that's all revenue, dividing by 2.5 trillion and multiplying by 50 billion. Challenge you all to get the zeros right the first time around on that. And that will give you the amount of the $50 billion allocation that you would be entitled to. Now, to the extent and then you take out from that the first allocation from the 30 billion to see whether or not you would be entitled to anything from the 20 billion allocation. This may come up with a negative number to the extent a provider is very heavy on Medicare. This will likely come out to a positive number if the provider is lighter on Medicare. And so up until last maybe Friday, Saturday, we didn't know much in terms of how the government has been viewing the idea of the negative number. We know slightly more now in that we believe either on Friday or over the weekend, the government added to the attestation page, and it's up on the screen now, on step 1 eligibility, they noted, please do not attest if the payments you've received already exceed your estimated total allocation, and to contact the hotline if you believe you've received an overpayment. This is all of the explanation we have at this point. We'll be certainly monitoring this to see whether or not there's any more explanation given, but certainly it's an ever-evolving area. So that concludes the update on the general distribution of the Provider Relief Fund. I'm going to hand over to Kayla, who's going to review the Main Street Business Lending Program.
Thanks, Holly. So many of you on the phone may be tracking information that the Treasury and the Fed have released on this Main Street Business Lending Program. During our last webinar, we explained that this was very much a throwaway line in the CARES Act, that potentially this would be developed by the Fed in the future. Well, we have recently gotten new guidance that I would say not only updates the program, but really overhauls it in the past week, coming out on Friday, May 1st. So we now have actually 3 programs under the Main Street Business Lending Program that were authorized under the Federal Reserve and are not explicitly funded by the CARES Act, but do have some ties back to the CARES Act and some of the potential restrictions that were included in it. So please do refer back to our old slides for the distinctions, but I've tried to include everything here in italics so you can know some of the key changes if you are considering these. So the total aggregate funding available is going to be approximately $600 billion. And the way this funding is done is it's actually going to be used to buy the loans from applicable lenders rather than going directly into the pockets of borrowers or being a direct finance function of the government to individual borrowers. So in order to participate in this program, you do need to consult your lender. There is a subset of eligible lenders that you'll see that we've listed here on this slide. And there are some nuances to this that I'll discuss as we get through each of the 3 loan programs. But just while we're looking at the overview here, you can see that. Unlike the PPP program that Amber discussed earlier in the webinar, these are not forgivable loans. However, if you receive a PPP loan and you still meet the eligibility criteria for a Main Street business loan, you may apply for that. So how does this work and what are the different types of loans under this new guidance that has come out? There are still the first 2 programs that were released and discussed on our last webinar, the Main Street New Loan Facility for brand new loans that are issued, the Main Street Expanded Loan Facility for loans that are currently in place. And then there's also this new program, the Main Street Priority Loan Facility. And this new program was released by the Fed as a result of some comments that they received in the industry looking for a facility that accommodated higher leverage for various borrowers, but still wanting a new loan. So previously, the expanded loan facility had a leverage ratio of 6 times EBITDA, and the new loan facility had a leverage ratio of 4 times EBITDA. The Main Street Priority Loan Facility is a new loan program that will allow a 6 times EBITDA leverage ratio. So it has become fairly attractive to a number of people. It has some additional strings, both for lenders and borrowers, that we'll talk about as we go along, but just to be aware that that new program has been released. Another update has been on eligible borrowers, and this is one place that many people were a little surprised by how the Fed interpreted new guidance. So you may have up to 15,000 employees to participate in this program, or $5 billion in 2019 annual revenues. So going back to the point that Amber mentioned earlier about the PPP program, the Fed has adopted the standard of affiliation that the SBA utilizes for calculating how many employees and what your annual revenues are. So if you've previously gone through that process for considering a PPP loan, it's going to be a very similar analysis that you're going to be asked to go through to determine if you're an eligible borrower for one of these new Main Street loan facilities. You'll see here on the slide there's a couple of other restrictions on eligible borrowers related to domestic operations and eligible lenders. But one key thing to note about all of these programs, because they are administered by lenders, they are given a fair amount of discretion for lenders to implement the program. So that means you're going to have to comply with the applicable lender's underwriting standards. They could require certain types of security. They are going to have broad leeway to calculate adjusted EBITDA as long as it's done in compliance with historical practices for similar businesses. So all of those things are going to be laid out in the current term sheets that the Fed has produced and are available on the Fed's website. So if anybody needs assistance in locating those, please do not hesitate to reach out. We're happy to send them, and it is quite a complicated process that you're going to want to discuss with your lender before jumping into, and consider your current relationships with any debt facilities to make sure that you're eligible under the applicable programs. So let's just jump into each of the individual programs themselves. The Main Street New Loan Facility, this is a loan facility where the government will be willing to purchase 95% of the loan from the applicable lender. They did lower the principal amount in the latest update from $1 million to $500,000. That was in response to a number of comments they received from the industry that the $1 million threshold was just too high. And then the maximum principal is going to be either $25 million or an amount not to exceed 4 times EBITDA when added with the other debt. So you're going to want to look at these particular thresholds, talk with your existing lender at how adjusted EBITDA is going to be calculated, because it will vary from lender to lender on how that is being done to make sure that the program is being administered in accordance with the term sheet. Again, this now can be either a secured or an unsecured loan. You'll have to consult your lender for information about that. And in the most recent update, there was more information that was released on the amortization. So just like we previously discussed on our last webinar, the annual principal amortization is able to be deferred for the first year, and then from years 2 through 4, the repayment schedule is 1/3 each year. And this is going to apply to only loans after April 24th. So anything prior to April 24th cannot be governed under this Main Street New Loan Facility. The next one is the Main Street Expanded Loan Facility. This was also present under the previous term sheets, but there has been a very significant number of changes. So the minimum principal now for these are $10 million, and the maximum principal you'll see here listed on the slide is a number of potential options, and it's the lesser of each of these 3 that are listed here. And this does have a leverage ratio of 6 times adjusted EBITDA. So you'll need to work with your existing lender to look at whether or not you meet those criteria. One thing that we've been asked pretty consistently about these loans is, what if my current loan only has one eligible lender? Under the recent guidance, there is the possibility that that loan can be an upsized loan under this loan facility. You should consult your existing lender to see if that's possible if one multi-lender facility is an eligible lender. And then again here, this is a little different than what was in the new loan program for principal amortization. So again, same thing for the first year that is deferred, But then in years 2 through 4, the payment schedule is 15%, 15%, 70%. So you'll see that in the term sheets when you take a look at those. So what people are really interested in that we have found, at least most of our private equity clients and other healthcare clients, are the new program, which is the Main Street Priority Loan Facility. So this one is brand new. It was not under the last set of term sheet or any information that had been previously released. This is going to have a minimum principal of $500,000, and these are going to be a little bit more risky loans because they are a 6 times EBITDA leverage ratio for new facilities rather than the 4 times EBITDA leverage ratio that is under the prior new loan program that was released. Because of this higher leverage ratio, the government is only willing to purchase 85% of the loan rather than the 95%, and it will have the amortization schedule that was set forth in the expanded loan, the 15, 15, 70% that's listed here on this slide. And this is going to apply to new loans. And I just noticed there's an error on the slide. It should say April 24th, not April 8th. So we'll get that corrected, but it is April 24th. So the next item is the key terms for all loans. So the term sheets that came out last week detail much of the important information, both for lenders and for borrowers, about how these loans will be administered. These are just a few very brief items that we think people should consider, and we have found that many of our clients are really concerned about, so that's the reason we've listed them here. The use of proceeds, this is a really key one, just like in the previous webinar that we mentioned. The proceeds may not be used to refinance existing debt, and that is a very key element that lenders will be held to and borrowers in the structure. And you'll see here a couple of other restrictions on the use of proceeds. For all of these loans, the maturity is going to be 4 years, and amortization and interest will be deferred for the first year. During our last webinar, I mentioned that one of the key comments that the Fed had received was about the interest rate and the calculation. They did change that during the most recent term sheet. They've moved it to LIBOR, which most lenders, I think, are pleased with. It's easier to administer and more common for borrowers to conceptualize, and that's going to be a LIBOR plus 3% on the interest rate with no prepayment penalties in any situation. And I mentioned earlier, but have listed it here again for your reference, lenders are required to calculate the adjusted EBITDA using historical calculations that are consistent with how they have either calculated your business's EBITDA in the past, or if you have not previously had a loan with them, how they've calculated the EBITDA of similar businesses in the past to yours. So that'll be an important piece. And we do expect, as this program moves forward, that there will be auditing and review by the Fed of these various certifications before purchasing the loan. So this is an important element that everybody really consider. Another thing that was of extreme focus during the comment period for the Fed were the distribution restrictions. So many of you probably know that have been following this program, there are pretty significant restrictions on the ability to make distributions, dividends, stock buybacks, and most people were very concerned for entities that were either partnerships or S corporations about the ability to make tax distributions. In the latest FAQ published by the Fed, they did make clear that tax distributions would be permitted. So that issue has been cleared up. And you can reference that, like I mentioned, in the FAQ that is on the Fed's website, along with the applicable term sheets. And then also reaching out to your lender to the extent that you're interested in this program is always a good resource. If you have any further questions about this program, don't hesitate to reach out to anybody on the phone. I'm always happy to discuss it. And we also have a group of our debt finance colleagues that are advising lenders and helping through this program that we're more than happy to connect you with and send you any information that would be helpful. So with that, Tim is going to talk a little bit about uninsured patient testing and care.
Thank you, Kayla. So this new program was launched by HHS with claims actually starting today. It is a reimbursement program. It is not a grant or a loan in that kind of traditional sense. Instead, it is basically a fee-for-service program that the government is setting up between the Health Resources and Services Administration and United Healthcare. The money comes from the same provider relief fund pot of money that the graphs were, or the charts were earlier in the slides. $2 billion has been appropriated by Congress for testing specifically for uninsured patients. And then the balance, the amount for care is right now going to just come from that provider relief fund. The government has said that reimbursement will happen until funds run out. So there is going to be a natural limit. Congress may appropriate more later, but to the extent you participate in testing or care for patients and they're uninsured and they're being treated for COVID, we strongly suggest you participate in the program early and get your claims in early. A couple things. You have to sign up for this program. Just because you're a Medicare or Medicaid enrolled provider, that's not enough. There is a separate sign up that you need to do. When doing so, you will attest to terms and conditions that are very similar to those that Holly spoke on. In fact, they took the same form clearly for both. They've added a few things here. A couple of the things they've added is, one, you have to check for the patient's healthcare eligibility and confirm that they're uninsured. They have employer-sponsored coverage, Medicare or Medicaid, some other type of, even probably workers' comp claims. If it's covered in some other way, they are not uninsured. And so you need to check for that. You need to agree that what they pay you, which will be the Medicare reimbursement rate for these services, is payment in full, no balance billing. And then you will be agreeing to all the terms and conditions and understand that you may have a post-reimbursement audit. They may review your records. This is not for everything. This is not a program to cover uninsured Americans. It's specifically for testing, including specimen collections, the tests itself, antibody tests, the testing-related visits, so the office visit or the hospital ER visit to get the test, that'll be covered as well. And then it will cover treatment for COVID-19, whether that's office visits, telehealth visits, inpatient hospital visits, skilled nursing facilities. All of that will be covered, but only if COVID-19 is the primary diagnosis. One exception that the government has said to date, for pregnant women, they will cover the pregnancy-related care, the delivery, if COVID-19 is a secondary diagnosis, understanding that some uninsured patients may have COVID-19 and they want to cover the care for the mother at time of delivery and then the new baby as well after born. So to do this, you can go to the HHS portal, sign up, attest to the terms, and then actually beginning today, the government will start receiving claim forms. They've tried to simplify this. They've allowed kind of a patient submission or patient roster that you can submit with the services you're providing. And you need to provide them some information in addition to the test or the care you provide. You need to kind of state who the patient is, their date of birth, their gender, their social security number and state of residence, and some of the other things on this slide. You need to then also separately attest with the roster that you checked for their uninsurance. So practically speaking, this is maybe an easier ask of care providers your office staff can kind of certify by going through with each patient. Do you have Medicare? Do you have Medicaid? Does your employer sponsor insurance? Did you sign up for Obamacare? Did you get some other type of state-based insurance coverage to respond to COVID-19? And kind of go through a list of questions. And then if in good faith you can attest, you can move forward. It may be more difficult in the lab context. Labs may have to rely on the service provider who took the sample, so you may want to put a process in place there to follow up with the care provider so that they can ensure that the appropriate care is being provided. One last thing I'll note is this asterisks. The Social Security number is going to be used to kind of speed the review and get reimbursement paid. They're hoping within 2 weeks of claim submission. If you do not have a Social Security number, like a undocumented immigrant or an illegal alien, depending on how they're categorized, what do? And to date, HHS hasn't said. The congressional appropriations doesn't limit this, but typically Congress and the administration hasn't, for instance, allowed Obamacare coverage to be used for those folks. Public health emergency, maybe for testing, it's more important. So we're hoping to get some more guidance there to see what kind of coverage might be available, but something in the short term you may want to be taking it, kind of keeping track of and documenting, and may not want to submit the claim quite yet to kind of wait for that further HHS guidance. So with that, I'll advance the slide and turn it to Gerald. Taxes are always important, and Gerald, and certainly last but not least.
Thank you, Tim. So allow me just to go over an issue that has come up recently, and it's also been in the news, and that's surrounding the deductibility of PPP loan proceeds. First, let me put it in proper context, especially since we have discussed on this call the PPP loan forgiveness requirements. So as many of you may know, any income that's associated with the forgiveness of a PPP loan is excluded from gross income pursuant to a provision of the CARES Act. This means that a taxpayer does not have to pay any taxes, income taxes that is, on a PPP loan forgiveness. That brings us to the issue of the tax treatment of the expenses that are paid that trigger the PPP loan forgiveness. The CARES Act addressed the income component with respect to the forgiveness, but it did not address the tax treatment of the payment of the expenses. Therefore, by staying silent on this issue, taxpayers were left to rely on general tax law principles and the current Internal Revenue Code in terms of determining the treatment. There, the pretty general principle is that if an item is not included in income, the related payment of the expense is therefore not deductible. Recently, in Notice 2020-32, which was provided within the past week, the IRS clarified that their position was that no deduction would be allowed under the code for an otherwise deductible expense if the payment of that expense triggered the PPP forgiveness and the income associated with that forgiveness was excluded. Essentially, the IRS and Treasury was taking the position that these otherwise allowable deductions would be disallowed to the extent that the expense item triggered PPP loan forgiveness. Well, that triggered quite a response from many Congress members, including House Ways and Means Committee Chair. And Congress did not disagree that, yes, that's true, this issue was not covered in the CARES Act, but the intent of Congress in passing the CARES Act was to provide a boost to various businesses. And therefore, by disallowing an otherwise deductible expense, this was going against their intent of passing these particular provisions in the first place. And therefore, I've seen many articles and statements by Congress stating that they most likely will make changes to various provisions in future legislation to address the deductibility of these expenses funded with PPP loans. So I would say to you for now to just stay tuned. While this is still an open matter, I suspect that Congress will address this prior to the end of calendar year 2020, and therefore taxpayers will be able to know whether or not they will be able to deduct these expenses. And if I were a betting person, although I shouldn't be in these times, I suspect that given the outcry and just the general circumstances that we're in, that we'll most likely see Congress pass a provision that would allow the deduction of this expense. But until then, I would just, again, stay tuned. The other thing I would like to mention here, although not noted on this slide, is that the IRS has continued to update their website on frequently asked questions with respect to the employee retention credit and when that is allowable to taxpayers. So I would just say to you that you should continue to monitor that website because at the moment we don't have any formal guidance on the employee retention credit. So that's the best we're going to have for right now. And just as anything, this is a continuing, evolving area, and we'll just continue to monitor and bring you abreast of any changes that we see. Thank you very much for allowing me to address the tax portion at this time, and I'll turn it over to my colleagues.
Thank you, Gerald, and thank you all for joining us. Again, it's a great honor to work with you during these difficult times. We've been trying to respond to many of your questions as we've gone. If we've missed any, we apologize, and we'll do our best here in the next couple minutes or after the webinar. But before we jump off in the next 5 minutes, Amber, I think a question came in about kind of the risk around not returning the funds by May 14th. Maybe they decided it was necessary, but it's a potentially questionable call. Amber, do you want to just spend a minute on kind of what we would expect to see in some of the upcoming Treasury audits and what kind of risk there might be?
Yeah, absolutely. So the question actually was posed as, would the penalty simply be that forgiveness wouldn't be available? Meaning that, and we have heard people have this discussion, meaning that might it be possible that the borrower can still keep the funds but under traditional loan terms? And the PPP loan terms are 2-year repayment, 1% interest, so quite favorable, just not forgiven. And we think no. They've been pretty clear that all of the necessity standards, all of these standards that have been under recent discussion have been for mere eligibility for the program at all. So we would expect that if a borrower applies and retains the funds after May 14th, that the onus is on the borrower, not the lender, to have been accurate in the certification. And Secretary Mnuchin has specifically mentioned the possibility of criminal liability. Now, that being said, of course, I think we can all recognize there are a range of behaviors that may lead the borrower to be wrong in their assessment of necessity. And I'm using air quotes, even though you can't see them. There's going to be a lot of really close calls, and there's not a ton of established case law or thinking to help make those close calls. So it is quite possible that there will be a range of penalties for being wrong, and the level of diligence and thoughtfulness that the borrower engaged in prior to both applying, but then again when making the choice to retain the funds after May 14th, that level of diligence will be the make or break in the level of penalties. So that's where we come back to really encouraging you to keep up with the guidance that we still expect prior to May 14th, and also to have gone through that real deep analysis on your cash flow position, your other available sources of credit, et cetera, and then to document that so that you are ready should you be looked into. And this is particularly true, again, for those who receive more than $2 million in their PPP loans, but it technically would apply to everyone. It's just the $2 million is the automatic audit trigger.
Thank you, Amber. And Holly, maybe last question here in the last couple minutes. Received a couple questions about kind of operating expenses from the kind of general distribution of the Provider Relief Fund. How are you kind of viewing operating expenses in the kind of the three buckets you set up? How are you kind of thinking about it when maybe there isn't full HHS guidance yet?
Sure, thanks, Tim. So, I mean, I think that general healthcare medical operating expenses are fair game to the extent they would have been paid with revenue that you have now not received as a result of COVID. So we kind of come back to that there needs to be a reasonable nexus with COVID. So if you were to use the funds to pay for those expenses 3 or 4 months from now when your revenues hopefully are much more normalized, that would be tougher. But to the extent in April or May you have a severe drop in expenses, and then you have, or in revenues, and then you have expenses that correlate with them for your operations, we think that would be likely defensible absent future guidance to the contrary.
With that, thank you all again for joining us. We know these are very difficult times, and it's an honor to have you with us. And please follow up if there are other questions. Reach out to any of us. We'd be happy to connect you and look forward to speaking further. With that, we will close today's webinar, and we hope you have a wonderful rest of today and the rest of the week.